What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please like this, please subscribe. Make sure you listen to this episode from start to finish. I promise you, you will not regret it. Please note that anything discussed in this episode is not financial advice. So please do your own research before investing into any stock. This episode, I want to provide some context around the Silicon Valley Bank's collapse, and I want to talk about how the Federal Reserve may respond to it. This is very, very important because two banks have collapsed within the last couple of weeks. Understand this is very, very important because the Federal Reserve will be providing an interest rate decision next week, and they will be giving us a summary of economic projections. They will be letting us know what they expect unemployment rate to be, what they expect GDP to be, and what they expect the ultimate terminal rate in terms of the federal funds rate to be. So I'm going to break this down, try my best to put this into context around how I feel about this particular bank and what the Fed may do. All right, let's go ahead and get into it. Okay, everybody. So I want to start off by talking about Silicon Valley Bank. And Silicon Valley Bank has been in the news because of its collapse. But I think it's important to just provide some context about this bank, okay? And I think it may be apparent to you all, as it was very, very apparent to me after I read this specific article, that Silicon Valley Bank just seems to me as an incompetent bank. Now, this article is about SVB, Silicon Valley Bank, and Silicon Valley's bank tech failings were a problem long before the bank run that led to its demise, critics say, which is very interesting. SVB's problems extended beyond its risk profile in a challenging economy. Now, Silicon Valley's bank historic meltdown last week was largely attributed to deteriorating business conditions in the firm's concentrated customer base and an ill-timed decision to invest billions of dollars in mortgage-backed securities. Now, Silicon Valley Bank is a bank that is known for investing into venture capitalists and VC firms. And a lot of VC firms and a lot of people that are in venture capital with money have their money in Silicon Valley Bank. But longtime clients and others with intimate knowledge of how SVB operated say the bank did itself no favors. Between the bank's refusal to upgrade its technology to meet the demands of modern day businesses and its treatment of many startup customers, SVB's problem extended beyond its risk profile in a challenging economy. An ex-SVB manager who worked on risk initiatives and asked not to be identified said the bank remained technologically stagnant even as it was a haven for startups that had an eye for cutting-edge software and products. As she described it, the back end of the bank is all bubble gum and wires. Now, that is very, very crazy to me, how you are investing money into startups who are supposed to be leading the technological revolution, and you are behind the eight ball. That is very crazy to me, and I don't really understand that. Now, 3 startup CEOs who bank with SVB agreed, telling CNBC that the user experience was often clunky and at times slow to fulfill requests. David Sillinger, CEO of physical security company Deep Sentinel, told CNBC that SVB fumbled its response to the COVID pandemic after the government initiated the Emergency Payment Protection Program, PPP. I know a lot of people know about PPP. The loans from the program were designed to allow companies to continue paying employees during the economic shutdown. It completely failed in the midst of all these companies needing to get their PPP funds, said Sillinger, who spent the majority of Friday trying to pull assets out of CVB. Now, that's very crazy how he was doing that on Friday. Now, Selinger, a former Amazon executive who has the backing of Jeff Bezos for Deep Sentinel, said his company had tried to use various automated services provided by SVB, but ended up having to do everything manually, clawing hand over foot trying to get PPP funds because the fulfillment didn't work. I love SVB, but that was horrible for our business, he said. They had written some code to try to make it faster and none of it worked. One CEO who had millions of dollars housed at SVB and asked not to be named described the bank system as terrible, slow, and the worst in the industry. He said the tech looked like it was built in 2002. In April 2020, TechCrunch reported on other SVB customers complaining that the bank mishandled the PPP process. CNBC sent an email to SVB's press address requesting a comment for this story, but we haven't received a reply. Now, I have to stop right here, everybody. I have to stop right here because all of these people are talking about how bad this bank has been doing. And this bank has been in existence for over 40 years, to my particular understanding from the research and the people that I have listened to. I don't understand why you have millions of dollars in this bank if this bank is such incompetent. It's just such incompetent, but I digress. SVB's swift collapse began late Wednesday when the bank told investors that it sold $21 billion worth of securities at a $1.8 billion loss and was seeking to raise additional capital amid a decline in deposits. By Thursday, as the stock was plunging and venture firms were telling portfolio companies to pull their money, Twitter lit up with people offering advice and making pleas. Some SVB defenders told their followers that they need to band together and support the 40-year-old bank, which has long been central to the tech ecosystem. One startup founder, Robert McLaws, responded to a particular tweet and offered a very different perspective. As an SVB financial customer for the last 5 years, they are terrible as an actual bank and are getting what they deserve, wrote McLaws, CEO of BurnRate.io. Their tech stack has not moved one iota. Their fees are punitive, and if you're not in SV, you're invisible, right? Billy, a partner at Two Sigma Ventures and an author of the original tweet, responded, "I have the opposite experience. I have loved every interaction with them." Another founder and CEO who's based in Los Angeles told CNBC he considered leaving the bank nearly a year ago after it took 6 weeks and 5 phone calls to transfer the funds needed to open the company's head office. He has $750,000 with SVB, which is triple the amount insured by the FDIC. The FDIC seized SVB on Friday following a run on the bank by depositors. It was the second biggest bank failure in U.S. history and the largest since the financial crisis 15 years ago. Now, understand this: banking regulators devised a plan to shore up deposits at SVB as they try to quell a feared panic over the firm. The central bank said it's creating a new bank term funding program aimed at safeguarding institutions impacted by the SVB failure. In addition, regulators said depositors at both SVB and Signature Bank in New York will have full access to their deposits, which is very, very good news. Roughly 95% of SVB's deposits are uninsured, which makes the bank particularly unique in that it serves primarily businesses. However, the risk of contagion led to a plunge on Friday in shares of other regional banks such as First Republic and PacWest Bancorp. Now, this last one, the lack of mobile security, this just digs right deep into this technological problem that this bank has. The former SVB manager who was hired to prepare the bank for a rapidly growing asset base said that implementing biometric authentication on the bank's mobile banking app was one of its technical failures. Startup finance execs were left with a password-based login to protect their funds because building authentication into the app was seen as too expensive and too complicated to do and not value additive to clients, the person said. Now, that statement is going to be very, very important on the next article that we're going to go to, but let's finish this very quickly here. Even attempts at shoring up its internal tech through a partnership with payments giant Stripe ended up flopping, according to the former SVB employee. In 2016, SVB announced an agreement with Stripe to launch a product called Atlas to give entrepreneurs everywhere access to the basic building blocks for starting a global internet business. Approved founders and execs found would receive a tax ID number, a U.S. bank account from SVB, a Stripe account to receive payments from anywhere, and services like tax guidance from PwC, legal help from Warwick, Harrington, and Sutcliffe, and tools and credits from Amazon Web Services. But the ex-SVB employee said after the big announcements, technically SVB wasn't able to pull it off on our end. The lack of investment in SVB's technology made the job of risk compliance difficult, the person said. Atlas works with fintech companies Mercury and Novo, according to its website. Stripe did not immediately offer a comment for this story. While SVB was undoubtedly one of the best banks for startups, the person continued, as clients grew, they were forced to switch because of the bank's inferior technology. Now, as I stated before we went to this article, Silicon Valley Bank seems to me like it was a bank that was incompetent. It was incompetent. It was not capable of doing the thing that it needed to do. But it still puzzles me that these people had millions of dollars into this bank and they were given inadequate services. The services that they were given were inadequate. But this kind of shows you that, a bank run of $42 billion in 48 hours does not happen from a bank that is competent, does not happen from a bank that has shored up everything that it needs to shore up. Now, what's even more interesting about SVB is going to be this next article that I'm about to go to. Now, this article is very, very disturbing, okay? SVB executives sold $84 million in stock over the past 2 years, stoking outrage over insider trading plans. Now, listen to this situation. Silicon Valley Bank CEO Greg Becker sold nearly $30 million of stock over the past 2 years, raising new questions over insider stock sales. Becker sold $3.6 million worth of shares on February 27th, just days before the bank disclosed a large loss that triggered its stock slide and collapse. The sale capped 2 years of stock sales by Becker that totaled $29.5 million, according to data from Smart Insider. He sold at prices ranging from $287 a share to $598 a share. Now, this is very, very crazy because this bank was just on a call saying that it had to shore up some deposits. But this individual, the CEO of the entire bank, sold $3.6 million worth of shares on February 27th before all this stuff happened. Okay. Something in the milk is not clean. Okay. Also, Becker also purchased options at lower exercise prices as part of the many sales and maintained his equity ownership stake. Other executives at SVB, including Chief Marketing Officer Michelle Draper, Chief Financial Officer Daniel Beck, and Chief Operating Officer Philip Cox, also sold millions of dollars worth of shares since 2021. Like I said, altogether, SVB executives and directors cashed out of $84 million worth of stock over the past 2 years, according to Smart Insider. The sales have sparked criticism of SVB's management, as well as the broader phenomenon of insider stock sales before major declines. Representative Ro Khanna, a Democrat from California, where the tech-focused bank was based, said Becker should return the money to depositors. I have said that there should be a clawback for that money, Khanna tweeted Monday. Whatever his motives, and we should find out, that $3.6 million should go to depositors. And I can't be mad at what he's saying, to be quite honest. Becker's share sales were part of a scheduled program known as 10b5-1 plan that was filed on January 26th, according to SEC filings. The 10b5-1 plans allows insiders to schedule stock sales ahead of time to reduce concerns over trading on insider information, Yet, SEC Chairman Gary Gensler has said the plans are rife with abuse, with insiders selling right after filing the plans, creating overlap or multiple plans, and/or by creating one-off scheduled sales. The SEC created rules which took effect February 27th and apply to plans filed April 1st. The rules include a more disclosure, transparency, and timelines for scheduled sales. It imposes a 90-day cooling off period between the filing date and the first sale. Under the new rules, Becker's sales, which came just 1 month after he filed, would not be allowed. I'm going to say it again. Under the new rules, the $3.6 million sale, which came just 1 month after he filed, would not have been allowed. That's very, very important. The SEC actually sent a strong message to inside sellers last month when it charged Taryn Pizer, executive chairman of OnTrack, with insider trading for selling more than $20 million of the company's stock before it plunged 44%. The SEC complaint alleges that Pizer knew about the potential loss of the company's largest customer when he established the selling plan in May 2021. Becker and other executives at SVB have also come under criticism for receiving their annual bonuses on Friday, a few hours before regulators shuttered the bank. On Sunday, the U.S. government struck a deal to backstop depositors at SVB and crypto-friendly Signature Bank. Now, I'm telling you, this goes into the narrative of why I feel that SVB is just incompetent. The bank could not have good technological makeup. Like, the technology from the bank was trash, okay? If we look at management didn't really care. They were all about making their money. So much so to where the CEO made a $3.6 million sale days before he made that announcement to the shareholders of SVB, and he even collected his own annual bonus. Okay, even collected his own annual bonus along with other executives. So I'm telling you, SVB, this situation does not look good. And to me personally, this wasn't a strong bank to begin with. They were making poor decisions. Okay, they were making poor decisions, and the management at the top of this, okay, was just poor management, in my particular opinion. Now, full disclosure, I just heard about Silicon Valley Bank last week when everybody else did. But based off of the information that I have gathered and what I have seen, everything that is going on with SVB is just not a good look. Now, I feel that this particular article right here is extremely important. Now, Goldman Sachs no longer expects the Fed to hike rates in March, cites stress on banking system. Now, Goldman Sachs no longer sees a case for the Federal Reserve to deliver a rate hike at its next meeting, citing recent stress in the financial sector. Earlier Sunday, U.S. regulators announced measures to stem contagion fears following the collapse of Silicon Valley Bank. Regulators also closed Signature Bank, citing systemic risk. In the light of the stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its next meeting on March 22nd, Goldman economist Jan Hazard said in a Sunday note. The firm had previously expected the Federal Reserve to hike rates by 25 basis points. Last month, the rate-setting FOMC boosted the federal funds rate by a quarter percentage point to a target range of 4.5% to 4.75%, the highest since October 2007. Now, Goldman Sachs economists said the package of relief measures announced Sunday stopped short of similar moves made during the 2008 financial crisis. The Treasury designated SVB and Signature as systemic risk, while the Fed created a new bank term funding program to backstop institutions hit by market instability following the SVB failure. Both of these steps are likely to increase confidence among depositors, though they stop short of an FDIC guarantee of uninsured accounts as it was implemented in 2008, they wrote. Given the actions announced today, we do not expect near-term actions in Congress to provide guarantees, the economist wrote adding that they expect the latest measure to provide substantial liquidity to banks facing deposit outflows. Goldman Sachs added that they still expect to see 25 basis point hikes in May, June, and July, reiterating the terminal rate expectation of 5.25% to 5.5%. Now, the narrative in the market has changed a lot over the last week. Just 1 week ago, we were having discussions about the Fed potentially raising interest rates by 50 basis points next week because everybody was concerned about the inflation rate and how inflation was happening. So they felt that the Fed may go the extra mile to go from 25 basis points to 50 basis points. But we just got our inflation reading recently, and inflation was right in line with expectations. And it is showing that the rate of inflation is cooling down, even though it's not dropping like everybody wants it to. It is indeed still going down. So this is what I particularly feel. I believe that there is a possibility that the Fed may say, you know what, we're not going to hike rates at this next meeting, because this is what we have to pay attention to this next meeting. The Fed is not just going to tell us what the interest rates are going to be. The Fed is also going to give us a summary of economic projections at this meeting. They're going to tell us what they expect the unemployment rate to be, what they expect GDP to be, and what they actually expect the terminal rate to be, because the Fed has to give us that information. Now, the Fed, I feel like they are not going to just not raise interest rates by 25 basis points this time and then pick back up in May, June, and July. I believe that that would defeat the purpose, because a 25 basis point hike is not going to affect the stress that has already been caused in the system. We've already seen 2 banks fail. And so if, hypothetically speaking, or if theoretically the reason why these banks failed was because of the tightening due to the Federal Reserve, that means that these 25 basis points that they hold off of or that they give on is really not going to make a difference in terms of the entire banking sector. So if the Fed does not, so pretty much, let's just break it down to what I feel. If the Fed does not raise interest rates next week by 25 basis points or even 50 basis points, and they don't raise interest rates at all, I believe the Fed is going to be done. Because for me, it doesn't really make sense for them to just not raise by 25 basis points this time and then raise in May, June, and July, because to me, that would show that they are panicking. They are panicking around what is going on, and the Fed does not want to panic. What they want to do is they want to ensure confidence. They want the American public to be confident in what they are doing. So I feel that they may raise by 25 basis points at this next meeting, but in regards to everything that has been going on, I believe that will give them a reason to pause, right? Because the Fed, they may not admit it to everybody else, but they may admit throughout the committee that, hey, y'all, we may have broken something in the economy. Something is going on with these particular banks, and this may provide a systemic risk. Because for me, I felt that if they were to raise by 50 basis points, the market would probably drop by 10%, because the market just would not be expecting a 50 basis point rate hike when they had already said that they were going to slow the pace of rate hikes, and they already came down to 25 basis points. I feel that 25 basis points would be a measured approach, because it's something that the market has already, it's something that the market is already expecting. You know, it's something that the Fed wants to do because they still care about inflation, but that would give them an opportunity to pause and say that, hey, we're going to monitor financial conditions here on out after we do the 25 basis point rate hike. Because if there is a bank contagion, and if something is actually going on in the economy, the Fed probably has a good idea about that. And they're not going to try to continue to tighten monetary conditions to make the bank system fail. Because at the end of the day, the Fed's responsibility and its mandate is to provide guidance on monetary policy, to provide guidance on monetary policy. So it's very, very important. And this particular FOMC meeting that Jerome Powell is going to have to lead may be the most important one that he has had in the last 12 months because of SVB, because of Signature Bank, because of everything that we have going on with the inflation and all the things of that nature. He's going to have to field those questions, and he's going to have to answer those questions, and we're going to have to see how is he going to respond to that. At the end of the day, banks collapsing, bank contagions, people taking money out of their banks, a lack of faith in the banking system is not good. And I know that a lot of people had to endure that 2008 financial crisis, and a lot of people have a fear as a result of that. But I want to tell you that whatever happens with this particular crisis, whatever the Fed does, whatever happens within the economy, it provides us an opportunity. And the only way that you can see it as an opportunity is if you have a long-term mindset and if you have some level of longevity. Let me break it to you down like this. Even if you're a day trader, even if you're somebody that's trading in and out of the market every single day, you still have to have longevity. The reason why you have to have the perspective of longevity is because if you don't have longevity, what's going to stop you from putting everything that is in your account into one particular trade every single day? What's going to stop you from doing that? If you have a level of longevity, that will allow you to institute what we call risk management, only putting a portion of your particular trading portfolio sizing into a trade, having risk management, having stop losses, understand that we are going to take money out of the trading account and pay ourselves as a result of that. When you have longevity, no matter what your time horizon is, you understand that I have to have that long-term mindset and see where the opportunities lie. Look, no matter what happens, I'm still a fan of you putting your money into the market and just coming into this game and understanding this game. I know that there are people that still have not invested into the stock market yet. So this is a perfect time. This is a perfect time with all this uncertainty, with all this fear coming in, for you to just put your flag down and say, hey, I'm here. I'm here for the long haul. I have longevity. I'm going to build wealth. I'm going to have an opportunity to make money and put me and my family into a position to be successful. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every single time that I drop an episode. Look, reach out to me in the comments. Let me know how you feel about Silicon Valley Bank. Do you believe that this is an isolated incident? Do you believe that this is going to affect other regional banks in the United States? Do you believe that this could cause a bank contagion to where it not only affects banks in the United States, but it affects all banks globally? Because at the end of the day, the US dollar is the world reserve currency. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.